Please come to question number 31. Question number 31 is P&L account only. Set out below are the draft statement of profit or loss of P and its subsidiary company S for the year ended 31st December 2017. On 1st January 2016, P purchased 75,000 ordinary shares in S from an issued capital of 1 lakh rupees 1 ordinary share. So what is the stake of the parent company? 75%. 75,000 divided by 1 lakh. Parent company owns 75%. So what is NCI share? NCI 25%. So that I will require for apportionment of profit of current year. Then revenue, cost of sale, gross profit, operating expense, profit from operations, then finance cost, profit before tax, tax, profit for the year. The following additional information is relevant. During the year, S sold goods to P for rupees 20,000, making a markup of 1/3. Only 20% of these goods were sold before the end of the year. The rest are still in the inventory. Tick mark revenue 1 tick and cost of sales 2 tick. Why 2 ticks? One for elimination of purchases and one for elimination of unrealized profit on the stock. Is it right? How much is the unrealized profit on the stock? 20% of the goods have been sold, means 80% has not been sold. So 20,000 into 80%, 16,000, and the markup is 1/3. 1/3 of cost price will be 1/4 of selling price. So URP will be 1/4 of selling price. So 1/4 into 80% into 20 lakh. How much is that? 1/3 of cost is 1/4 of selling price. So how much is this? Assume. Anything, whatever we will do, there will be a question mark. If I take 1/4 of selling price, 1/3 of selling price, again the assumption. How much it comes to? 20 into 80% into 1/4. 1/4. 4. Next line, point number 2. Goodwill has been subject to an impairment review at the end of each year since acquisition. And the review at the end of this year revealed another impairment of 5. 5 is missing, I think. This year there is an impairment loss of 5. Another impairment of 5. The current impairment is to be recognized as operating cost. Tick mark operating cost. In operating cost, I will add one more item. Goodwill impairment 5. At the date of acquisition, a fair value adjustment was made, and this resulted in an additional depreciation charge for the current year of rupees 15,000. It is the group policy that all depreciation is charged to cost of sales. Tick mark cost of sale one more time. So 3 adjustment in cost of sale: elimination of purchase, elimination of unrealized profit, and additional depreciation of 15 will be provided. Next line. P values the non-controlling interest using the fair value method. Will this affect my answer? Yes. While calculating the share of NCI in the profit of subsidiary, impairment loss of goodwill will also be considered. Is it right? So all adjustments made in subsidiary's profit, including goodwill impairment, will be considered. Now we will solve. Prepare the consolidated statement of profit or loss. So dear student, first come to consolidated statement of profit and loss for the year ended 31st December 2017. Is it right? So start. Sales. First take total of both companies. What is the date of acquisition in this problem? First January 16 means last year. So current year entire sales will be added. 600 plus 300. Is there any intercompany sale transaction? 600 plus 300. And what is intercompany? 20. So give me the answer now. 880. Cost of sale P Limited is 360. S Limited is 140 less intercompany purchases in bracket 20. And there is one more adjustment here. As we discussed that, point number 1 in your question, during the year S Limited sold goods to P for rupees 20,000, that we have done, making a markup of 1/3. So assuming 1/3 of cost, only 20% of these goods were sold before the end of the year. So write down less unrealized profit on stock 1/4 into 80% into 20. So this is less or add? That is a question. Add. Why add? Cost of sale will go up. If you remove the unrealized profit on the stock, closing stock will go down. If closing stock goes down, cost of sale goes up, right? So plus, no problem. This is my cost of sale. Don't take the total, one more adjustment will come. Gross profit will not calculate. Operating expenses. Operating expenses P Limited is how much? P Limited operating expense, is it 93? Then next one, S Limited is how much? 45. 93, 40. Keep it here only. There is some adjustment, will come to that. Next line, finance cost. Finance cost has no adjustment. So you take the total. Is it 3? 3 in the outer column. PBT will calculate later. Tax, there is no adjustment. So how much is profit before tax? Tax is 50 plus 32. 82. Sure. So write 82. Profit after tax we will calculate again. First adjustment we have done. Second adjustment. Goodwill has been subject to impairment. And what is the current year impairment? 5. Where they have asked us to take goodwill impairment? Operating cost. So goodwill impairment. How much this had? 5. So write 5. That also you will add in operating cost. Goodwill impairment 5. This total you can do now. 93 plus 45 plus 5. 143. Come to adjustment number 3 in your question book. At the date of acquisition, a fair value adjustment was made. This has resulted in an additional depreciation for current year rupees 15,000. Group policy is that all depreciation is charged to cost of sales. So come to cost of sale, one more item add. Depreciation. How much is depreciation? 15 for this year. Now you take this total in the outer column. 499. Only 20 you will deduct, all others you will add. Now you tell me total of B. Total of B means total of expenses. Total of expenses. 640. Okay. Now you tell me PBT. A minus B. 235. Tax is 82. Profit after tax 153. Next is share of profit attributable to NCI. How much is NCI share? 25%. 25%. 25% of, not this figure. Wait, don't be in a hurry. 25% of subsidiaries profit. Subsidiaries profit for there is 80, but not 80, because that 80 also has undergone change. What are the changes in that 80? You see on the screen. First check whether it is an upstream transaction or a downstream transaction for the stock. Upstream. So this means this 4. Can you see this 4? NCI will also get a share in that 4. So I will reduce the profit of the subsidiary by 4. Then you see this depreciation 15. Subsidiaries depreciation. So NCI will get a reduced share in the profit because of depreciation. And then you see this goodwill. Now whether I should write goodwill also if the NCI is at fair value. Yes, then they will also share goodwill. So this also write down 5. Now tell me 80 minus 4 minus 15 minus 5 into then 25%. Is it 14? Total profit of the group is 153. NCI share, NCI will only get share in the profit of subsidiary. So parent company's share is 153 minus 14. 139. Is it right? This 4 is unrealized profit. This 15 is depreciation. This is goodwill impairment. And this is their profit after tax from their separate profit and loss account. This answer is over. Assumption write down. It is assumed that markup of 1/3 is on cost price. It is assumed that the markup of 1/3 is on cost price. Okay, now we'll come to next question. 32. Question number 32. This time you have to prepare both SOFP also and SOPL also. P Limited acquired 70% of S Limited 3 years ago, when S retained earning were 4,30,000. So first you underline 3 years ago. So 3 year will be required in some calculation, and pre-acquisition retained earning is 4,30,000. The financial statement of each company for the year ended 31st March 2017 are as follows. SOFP on 31st March 17. PS rupees in 1000. Non-current asset. Property, plant and equipment. Investment in asset cost, current asset. Total. Share capital. Share premium. Retained earning. Non-current liabilities, current liabilities, total. SOPL for the year ended 31st March 2017. PS revenue, cost of sale, gross profit, operating expense, profit from operation, financial cost, investment income, profit before tax, profit for the year. Now understand, P&L account is prepared for only 1 year, okay? Whereas the balance sheet is the cumulative effect of last 3 years. So sometime the same figure which will go to profit and loss will not be written in SOFP, because SOFP will give accumulated effect, whereas in SOPL will only give current year's impact. You are provided with the following additional information. S Limited had plant in its SOFP on the date of acquisition with a carrying amount of 1 lakh but a fair value of 1,20,000. So what is the appreciation? 20,000. Tick mark property, plant, equipment. You will add 20,000. The plant had a remaining life of 10 years at acquisition. Depreciation is charged to cost of sale. In the SOFP, you will provide depreciation for 3 years. Accumulated depreciation for 3 years in SOFP. But in the profit and loss, you will provide depreciation only for current year, 1 year. So 20 divided by 10 means the depreciation charge is 2 per annum. So 2 will go to P&L account, and 2 into 3, 6 will be deducted from SOFP, property, plant and equipment. Is it clear? I'll just explain again. 20 divided by 3, 2 per annum. So current year 2 per annum. Huh? Sorry, 20 divided by 10. 2 per annum. This will go to P&L account. And 2 into 3 years, 6 in adjusted SOFP. Adjustment number 2. And in where will you write in SOFP? In cost of sale. Tick mark cost of sale. Cost of sale. One more item, depreciation 2 will be added. Next line. The P group values the non-controlling interest at fair value. So again, if there is a goodwill impairment, you will adjust in NCI also. The fair value of the NCI at the date of acquisition was rupees 2,50,000. Goodwill has been impaired by a total of 30% of its value at the reporting date, of which 1/3 related to current year. So goodwill also you do the same thing. Current year only adjust in profit and loss, and all 3 years adjust in SOFP. Okay. Be careful, same figure will not be transferred to SOFP. P&L account is for current year only. SOFP is as on a given date. Point number 3. At the start of the year, P transferred a machine to S for 15,000. Who transferred to whom? P to S. Who has made the profit? P. Okay. Will the NCI get a share in that 5 profit on 15,000? No. The asset had a remaining useful life of 3 years at the date of transfer. It had a carrying amount of 12,000 in the books of P at the date of transfer. So what is the profit made by parent company on the transfer? 3. 15,000 divided by 15,000 minus 12,000, 3,000. And what is the life of the asset? 3 years. At the start of the year, this transaction have taken place. So which means you have to also reverse depreciation. In whose book depreciation will be reversed? S. And who has made the profit? P. So this profit will be reversed in P's book. This depreciation will be reversed in S books. P has sold to S. P made the profit, S provided the additional depreciation. Dear student, come to next adjustment. During the year, S sold some goods to P for rupees 60,000. S sold to P upstream at a markup of 20%. 20% of what? 20% of cost. So in previous question we have assumed cost. So now also we'll assume cost only. No, we will not change. Otherwise student will get confused. Already CA means confused student. Okay. 40% of the goods remain unsold at the year end. So we'll have to create some unrealized profit on 40%. At the year end, S book showed a receivable balance of rupees 6,000 as being due from P. This disagreed with the payable balance of rupees 1,000 in P's book due to P having sent a check to S shortly before the year end, which S had not yet received. Okay. So what is the treatment? Go to receivable minus 6,000. Go to payable minus, from payable how much will you deduct? 1,000. And how much is check in transit? 5. Check in transit 5. S Limited paid a dividend of 20,000 on 1st March 2017. You will see in the profit and loss statement some investment income is appearing. Okay, tick mark that investment income. Some portion of that investment income is dividend received from subsidiary company. So to the extent dividend relates to subsidiary company, we will eliminate. Okay. Prepare consolidated SOFP and consolidated statement of profit or loss for the year ended 31st March 2017. So one by one, understand. First, you have to prepare formats. Check consolidated balance sheet of P Limited, consolidated statement of change in equity, consolidated statement of profit and loss. 3 main format, followed by one analysis of profit and calculation of goodwill working. And then one small working note will prepare for finding out the share of NCI in the current year's profit. Okay, because profit and loss account is for 1 year. You can say that why don't we take the figure from post acquisition profit? This will be for 3 years. Like in earlier problems we had done, we used to take figure from this working note. In this question, this cannot be done because this will cover 3-year period, but I need to only find out the current year profit. Share in current year, so this small adjustment we will do. Is it right? So can we start this amazing question? So start with property, plant, equipment. First you just write down here 900 plus 400. Just write down there 900 plus 400. Is it right? How much it, and don't take the total because there are many adjustments there. Keep it as it is. Investment in S at cost. Where will you write, dear student? Consideration paid, working note, goodwill, 700. Next item is current assets. Current asset, you come to this other current asset and just write down here for the time being 300 plus 600. Continue, don't say it. Share capital. What is parent's company share capital? 200. So write 200. Write in this SOCIE also. Share capital. Wait. Is there any share premium in parents column? 50. Right here 50. Is there any retained earning in parent column? 1350. Okay. Now let us look at the subsidiary. What about subsidiary share capital? Subsidiary share capital, is it 150? Where will you write? Goodwill working note. Write 150 here. And subsidiaries retained earning 700. And in the paragraph at the beginning they have said pre-acquisition retained earning was 430. So come to working note 1. In analysis of profit, write retained earning, pre-column 430, post column 700 minus 430. Is it 270? Right here, we'll come back to this. Then we have non-current liability. Non-current liability, no adjustment. Write total in the outer column. 100 plus 90. Is it 190? Write in this outer column total 190. Current liability has some adjustment. Write 200 plus 60. We'll come back to this, okay? Then we'll come to SOPL. Sales. Sales is how much? 1000 plus 260. And there is some adjustment also, which we'll do later. Let me first complete line by line whatever is given. 1000 and plus 260. Next, cost of sale. Cost of sale P Limited is 750. S Limited 80. Next line, gross profit will not write. Operating expenses. Operating expenses, how much? 60 plus 35. How much? 95. Then profit from operation. Finance cost 25 plus 15. 4040. Investment income. So here you write investment income in the sales and investment income. Just write 20. We'll come back to this. Then profit before tax don't write. Tax write down. 100 plus 30. 130. Profit for the year we'll calculate. Okay. Now you ensure double effect properly. You are provided with the following additional information. S Limited had a plant at the date of acquisition with a carrying amount of rupees 1 lakh but having a fair value of 1,20,000. The plant had a remaining life of 10 years at the acquisition date. So you come to SOFP PPE. What is the increase in the value of the plant? Plus 20. Can I write plus 20? Okay. And what about the depreciation in the SOFP? 20 divided by 10 into 3 years are over. 6. Yes or no? So write minus 6 here. 20 divided by 10 into 3. Wait a minute. Now, what are the other effects of this? We will go to statement of P&L account. Cost of sale will include now depreciation also. How much depreciation? Add depreciation on revaluation. Now here we'll write only 20 divided by 10. 2. Because this is current year P&L account. And then we'll go to analysis of profit also. And there we will write revaluation, fair value adjustment right now. Fair value adjustment on property, plant, equipment 20. Pre-column less additional depreciation on revaluation for 3 years, that is 6. 20 upon 10 into 3. Okay. Correct. This adjustment is over. Now come to point number 2. P group values NCI at fair value. Fair value of NCI on the date of acquisition was 2,50,000. So write down in working note 2 NCI on the date of acquisition 250, and also write in statement of changes in equity 250. Next line, goodwill has been impaired by a total of 30% of its value at the reporting date. But have you computed the goodwill, of which 1/3 relates to current year? So once we compute goodwill, then we'll do this adjustment. So remember, one adjustment is still pending. Next line, at the start of the year, P transferred a machine to S for rupees 15,000. The asset had a remaining useful economic life of 3 years at the date of transfer. It had a carrying amount of rupees 12,000 in the books of P at the date of transfer. How much profit they have made in this? 3,000. Who has made the profit? Parent company. So first one, we will remove the profit from the property, plant and equipment. So -3. -3. And then we'll go to profit and loss statement. You've written investment income 20 here. Where is that profit transferred by this company? It must be transferred to somewhere in the profit and loss statement only. Is it right? So -3 you write here. -3 in bracket profit on sale of fixed asset. Who has provided depreciation on this 3,000? Subsidiary. So we will reverse the depreciation. So you go to SOFP again, write down +1. What is this +1? Reversal of depreciation. 3,000 upon 3 years. 3,000 upon 3 years. Okay. and then we'll go to profit and loss also. In cost of sale, write down less reversal of depreciation, in bracket write 1, in bracket write 1. And then you also come to analysis of profit. You also come to analysis of profit, and you write there reversal of depreciation in post column 1. Come to adjustment number 4. During the year S sold some goods to P for rupees 60,000. So come to statement of profit and loss. Sales reduce 60, and cost of sale also less intercompany purchases. Is it 60? Yes. Sales you can write in the outer column. 1000 plus 260 minus 60, 1200. Slowly and slowly you will do. Don't take this total, some more adjustment I think may come. Wait a minute. Next line. At a markup of 20%, 40% of the goods remained unsold at the year end. So we will calculate the unrealized profit on stock. Okay. Come to your consolidated statement of financial position. In other current asset, how much will be that unrealized profit? 20 by 120 into 40% into 60. How much it comes to? 4,000. Sure. 4,000. This is 4. Is it 4? Then we'll go to P&L account also. In that cost of sale, you will add unrealized profit on stock 4. Unrealized profit on stock 4. And then you go to the pre and post working also. Less unrealized profit on stock in bracket 4. Done. Now some simple adjustment. S Limited books showed a balance of rupees 6,000 as being due from P. So where will you present 6,000 balance due from P? It must be in the other current asset. Yes or no? So write down minus 6,000. Minus 6,000. Minus 6,000. And then it says this disagreed with the payable balance of 1,000. So from payable current liability, you write minus 1000. And what is the reason? P had sent a check shortly before the year end which S had not received. So in cash and cash equivalent, you write down check in transit. Check in transit 5. 6 minus 1. Now you tell me the current asset figure also in the outer column. 300 plus 600 minus 4 minus 6. 890. Tell me the current liability figure in the outer column. 200 plus 60 minus 1. 250. 259. Okay, very good. And you tell me the property plant equipment figure in the outer column. 900 plus 400 plus 20 minus 6 minus 3 plus 1. 1312. So far so good. S Limited had paid a dividend of rupees 20,000 on 1st March 2017. So now you come to profit and loss. From this investment income, you adjust the intercompany dividend. How much dividend they must have received? Is it 70%? 70% into 20. That is 14. So my net investment income will be 3. Okay. This is current year profit. All adjustments are over or something is pending? Huh? Impairment of goodwill. Oh, wonderful. So first let me check whether this working is complete. Second impact. Where will second impact be transferred to? This profit that is appearing in the books, this 270, it is after dividend or before dividend? It is after dividend only. Because it is taken from the SOFP and dividend has already been paid. So we will assume dividend has been paid out of current in the last 3 years profit only. So means out of post acquisition profit only. Okay. If you add back, again you have to deduct in the SOCIE. Okay. Or you can ignore that also. Still it will match. If you'll add back here, then you have to deduct in the SOCI respective amount. Or if you don't do anything, then also the effect will be the same. We should add it. Okay. Add. Dividend paid. How much is that? 20. Statement of changes in equity. Less dividend 14 6. Okay, first we will okay, we'll see. यहाँ पे देना unrealized profit on PP 3, because we'll not take figures from there, we'll take figure of 3 years. 3. We will see last man that whether all figures have been considered or not in our calculation. So unrealized profit on PP, yes, you're right. You write there also from retained earning 3. Okay, now just have a look at the answer. Have you done everything? Goodwill, huh? But before goodwill, I need to ensure profits are logged. So goodwill impairment is pending. For that, I require pre-acquisition figure. So tell me, what is the total of pre-acquisition column? Is it 450? And what is the post column total? 281. 24. Okay, no problem. Then who are the parent company? P share is how much? 70%. Only post column, tell me the figure. 196 point. Very good. NCI 84.3. Okay. Now 450, you transfer here 450. So tell me, what is the total of A, these two figures? 950. Total of these two numbers 600. Goodwill 350. How much goodwill has been impaired? 30%. So 30% of 350, 105 has been impaired in the last 3 years. So what is goodwill left on the date of consolidation? 245. 245. Out of 105, current year share will be only 10%. One third of it. So where should I go now? First I'll go to SOPL, goodwill impairment, 1/3 of 105. Is it 35? And then you also go to SOCIE, goodwill impairment. Both parties will share 70% and 30%. 70% of 105. 73.5. 30% of 105. 31.5. So total 105 we have impaired. Now wait a minute. Goodwill in the SOFP, that is balance sheet. How much goodwill you will write? 245. Okay. So now all adjustment to my understanding is over. Let us come to profit and loss. What is the total of cost of sale in the outer column? 775. Total of all expenses. 775 plus 95 plus 35 plus 40. 945. Total of income 1203. A minus B. A minus B. How much? 258. PAT is how much? 128. Now this is current year profit and loss. So NCI share will not be 128 into 30%. Wait, again. It is the total profit of the group. NCI will get share only in subsidiaries profit. Right? Now subsidiaries profit and loss account given to us shows a profit of 100 made by the subsidiary. But that requires certain adjustments. For example, the depreciation on revaluation. The profit is without considering depreciation on revaluation. So this I will consider. The profit is also without considering reversal of depreciation in subsidiary book. Unrealized profit on stock. Yes or no? And what about goodwill also? Because it is based on fair value. So goodwill impairment. So the profit of the subsidiary for calculating NCI share will be adjusted for depreciation on revaluation, reversal of depreciation on profit, unrealized profit on stock, and goodwill impairment in case goodwill is based on fair value. So I have prepared a small working here. Calculation of NCI share in the current year profit. So what is the profit after tax of subsidiary? 100. Less unrealized profit on stock. 4. Less depreciation for 1 year on revaluation of PPE. How much was that? Depreciation on revaluation? That was 2. Add depreciation on transfer of PPE reversed. 1. Goodwill impaired for 1 year. 35. So net profit for computing NCI share. 60. Decide final. 30% of 60. NCI share in current year profit. Is it 18? Is it understandable? Is the total 60 or 61 here? Okay. 18 is NCI share. So we are on the profit and loss statement again. NCI share 18. Right, refer working note 3. Parent share balancing figure 110 110. So P&L account is logged. Now we have to close SOCIE. In SOCIE, we have to add the profit. Which profit I have to add? Post acquisition profit. The one which you computed just now, or the one which is based on pre and post acquisition profit? Yes, analysis of profit post acquisition. How much was the share of parent company in that? 196.7. 196.7. This you write down working note 1. Goodwill impairment, right? Working note 2. And how much was minority share, NCI share in the post acquisition profit from working note 1? 84.3. 84.3. Okay, now you tell me the total of opening balance line. 18? Write neatly. One day this question will come in your exam also. And then take total of post acquisition profit, both figures. 281. Goodwill impairment 105. Unrealized profit on PPE 3. Dividend 14 and 620. Now take total of each column. 200. Then 50. Retained earning. Anybody retained earning total? 1456.2. NCI total 296.8. Total of total 2003. This figure we have written already in the balance sheet. What is the total of security premium and retained earning? 1506.2. 1506.2. And this is NCI. So write down other equity 1506.2. Total of this 2 is how much? 1706.2. NCI was how much? 296.8. Oh, 296.8. Now tell me the total of the asset side. 2452. And this side same. Amazing. Okay, this answer is over. Over. So then why are you waiting? Why don't you read next question? Question number 33. P Limited acquired 30% shares of S Limited on 1/4/18 for rupees 1 lakh. P Limited applied IFRS 9 on such investment on 31st March 19. P Limited revalued investment at 1,20,000 through profit and loss. So with 30% they don't have the control. So till that time they will follow other standards like IFRS 9. And the change in fair value is recognized in profit and loss account. Then on 31st March 2020, P Limited acquired another 40% share in S Limited for rupees 2 lakh. So now 30 plus 40, they've got 70% share. So this is an example on step acquisition. Now they will start preparing consolidated financial statement. P Limited acquired 40% share for 2 lakh. Previously held investment will be revalued. Is it right? Assets, PPE investment in S Limited. Current asset. Now this investment in S Limited, it seems it is the 30% share only. Okay. Current asset, equity and liability, share capital, reserve, NCL. Fair value of S Limited 30% lot on 31st March 2020 was rupees 1,50,000. So I have to revalue that previously held equity interest also. And how this consideration for 40% share was made? P Limited has not journalized the acquisition of second lot, which was a cash acquisition. So you have to pass entry for purchase of investment to cash. How much amount was paid? 2 lakh. 2 lakh, 2 lakh. Okay. What is the question? Prepare the consolidated SOFP. That's it. So first you see the format that I will require. One, I will require CBS of P Limited, consolidated balance sheet, or you can write SOFP on 31, what is the date? 31st March 2020. Make it March, 31st March 2020. Then I will require one statement of changes in equity. What is the year ending date? 31st March 2020. And when was control acquired? 31st March 2020. All profits of the subsidiary will be treated as pre-acquisition. Okay. One more working note in this question I have prepared is journal entry on the date of acquisition, and one working note, calculation of goodwill. Right? What about NCI valuation? Is the NCI valuation given to you? No. Then what will you assume? Proportionate share in net asset or fair value method? Fair value. Proportionate share. Okay, your choice. Proportionate share. That's it. Can we start now? First, what you do? First, you come to these journal entries. On the date of acquisition, I will pass two journal entries. One, purchase of investment. So write investment in S Limited account debit 2 lakh. To bank account 2 lakh. You are writing in lakhs, so just write 2. All figures will write in lakhs. And then you have to revalue the existing investment Investment in S Limited account debit 1.50 minus 1.20. So the increase in the value of the investment is 0.30 to P&L account 0.30. Done. And this profit on revaluation of investment in S Limited, you write in statement of changes in equity also 0.30. Now we'll start solving the problem. Start with PPE. Is there any adjustment? No. Total of 15 plus 10, 25. Investment in S. Now come to this working. Consideration paid for 40% share is 2. Fair value of the previously held equity interest 1.5. The journal entry we have passed for this. Back to balance sheet. Current asset. No adjustment. 8.8. There is an adjustment. You have paid cash. 8.8 minus 2 cash paid and plus subsidiaries cash, subsidiaries current asset plus 2. So we will write 8.8. Share capital right here. Parent company 10. Parent company share capital also write in statement of change in equity. Parent company reserve also write here 10. And these two figures, subsidiaries 6 and 5 right here, 6 and 5. So total is 11. So if NCI you want to use net asset, then NCI share will be now how much? 30% of 11, 3.30. Total of these three numbers, 2 plus 1.5 plus 3.3 is how much? 6.8. And this total is 11. Oh, this time we have gain on bargain purchase. So GOBP. How much is that GOBP? 4.20. Is it 4.20? We'll go to this gain on bargain purchase. Write 4.20. And how much was NCI you have calculated? 3.30. One more item is pending in the SOFP, non-current liabilities. Total 5 plus 1. Is it 6? Okay, now we'll complete this table first. SOCIE. 10 plus 10 plus 3.30. 23.30. Gain on bargain purchase total line 4.20. 0.30 in the last column. 10. Retained earning total 14. 14.5. NCI total 3.3. Total column 27.80. So now we'll come to retained earning and NCI in the SOFP 14.5. So total comes to, in the outer column, 24.5. NCI is how much? 3.3. So what is the total of the asset side? Total of the liability side? 33 point. Oh, amazing. Tallied. Is this answer over? Yes. Done. Next question after the break.